Our next guest does prefer some growth and cyclical names to manage some of this choppiness going into year end. Joining us here at Post 9, Citi's U.S. equity strategist Scott Chronert, S&P target of 5,600. Scott, great to have you back.
Carl, thanks for being
here. Since we last talked, we got China stimulus. A couple of strikes are now in place. Obviously, what's happened in the Middle East, does any of that change your overall playbook?
Well, the Middle East is, sort of ongoing wild card. Geopolitics is something we keep an eye on, but trying to translate it into fundamentals has been a little bit trickier. Going back to Russia, Ukraine, and now the ongoing Israeli situation. So, we're keeping an eye on that. What we did do tactically was go overweight energy going into Q4. So this is over the weekend. And there we think the setup allows for some potential beneficiary of that continuing to flare up. But I'd say it's a little bit more of a contrarian call right now.
Does that move in on your monetary policy forecast?
Well, essentially, the way this goes in terms of the monetary policy setup is that we still think we're in this less restrictive mode. We're not to the point yet where we can say, hey, look, at the Fed is at this point being accommodative. So what we're looking to do is balance here in terms of growth as defensive as a play into the end of the year. We want to marry it with some cyclicals, and then we've been ongoing overweight financials via the banks, and now we're adding energy to that. So essentially, what we're doing here is avoiding the more defensive parts of the market, which in our view are generally historically expensive. Healthcare, a little bit of an outlier to that. We've been underweight for the better part of the year. We don't see any urgency to go back to those sectors. We prefer to either go down the growth path or begin to kind of set up for the other side of this hawkish Fed narrative.
So is it the bet that, though, the Fed has to stick the soft landing for that to work?
Well, I mean, I think the bet is that the Fed trajectory from here continues lower. The market's telling you we're prepared for as much as 200 basis points.
But the market's been wrong on that before.
The market's been wrong on that. But I do think that the setup here, in our view, is one where fundamentally we think we're still looking at a pretty good Q3 earnings reporting season. That said, we did go underweight industrials, and the spin there is very, very clear. Relative performance has been pretty good. Valuations have gotten pretty expensive. We think there's going to be some, quote, fraying around the edges from a fundamental perspective as we go through Q3 reporting, and we think that takes some edge off of the price action in that part of the market.
Is the bigger risk that the Fed doesn't cut as much, or that the economy performs worse than expected?
So from our perspective, the bigger risk is that the Fed needs to stay ahead of the narrative here, and we don't want to fall too far behind if you do begin to see some further deterioration in the labor circumstance, which is essentially a house economics call, that we will begin to see a bit of a downward spiral or deceleration in labor. I don't think that necessarily means we have to be at recession.
But that just means they're going to be cutting more. I mean, isn't it a bigger risk that we have some sort of reflation because financial conditions are so easy, commodity prices are rising again on geopolitics, and they won't be able to cut? So
I'd argue that risk is more of a 25 risk, but a little bit different, right? So we're talking about the election in nearly every conversation. And our view is that both candidates are mostly fundamentally negative for U.S. equities, but we have that lingering deficit discussion around spending in the background. So when I look at the rate environment, I think the Fed's on a path where they can continue to ease, and I think that's net constructive versus the past 2-year narrative. But as you get further into 2025 and we continue to go down this debate around how to finance the deficit, then you begin to risk things like the bond market vigilantes coming back. Do rates back up for other reasons, Sarah, that maybe are a little bit less tied to the traditional economic circumstance?
Finally, what's your number for Friday?
Well, I don't have a number specifically on that, but what I would say is that I think we're prepared and positioned that it's going to be supportive of, with the current Fed trajectory. House view is that you potentially get 50 in November. I'm happy with 25 or 50. I want to see the trajectory continue is the main point for me.